It's the dominant theme in global macro and markets. But how has the breakdown of US-Chinese relations changed since Donald Trump returned to office? Join our economists this fall for in-person briefings on global economic fracturing under Trump. We look forward to seeing you in Hong Kong, Singapore, New York, and London for a deep dive into the market risks and strategic challenges ahead. Sign up at capitaleconomics.com/events to join the conversation.
It's Friday, 8th of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, will Donald Trump fulfill his promise to get manufacturing jobs roaring back to the United States? But first, Neil Shearing, Group Chief Economist, joins me to rake over the coals of another week in global macro and markets. Hi, Neil.
Hi, David.
Let's get straight to it. The Bank of England met on Thursday, so yesterday. It was an interesting meeting. It feels kind of like what we've seen with the Fed in recent months, where you've got a group of policymakers who are split on whether they need to worry about what's happening in the jobs market or whether it's inflation that's the bigger concern.
Yes, a really interesting MPC meeting. And I think it cuts across another big theme of the past week, which has been concerns over the integrity of data, which we can come to. But just on the MPC meeting itself, initially a three-way split. One member of the committee voting for a 50 basis point cut, 4 voting for a 25 basis point cut, and 4 voting for no change at all. And I think it speaks to the fact that the UK economy itself at the moment is incredibly difficult to read. The fact we have this group of policymakers, 9 of them, seemingly taking 3 different separate views of where the economy is heading. Now, in the event, they cut interest rates, as you say, 25 basis point cut, but it was a pretty hawkish cut, damping down expectations of further cuts in the short term. And we've obviously seen a bit of a sell-off on the short end of the UK gilt curve and a rally in the pound since too.
Talk about this uncertainty. Talk about the difficulty of reading what's happening in the UK economy. This is partly about the quality of the UK data, isn't it? Particularly employment data. And we have got a fresh set of UK employment numbers in the coming week. So what do you think those numbers are going to say? And how is this data question feeding into the debate?
The numbers themselves, you're right, we've got some labour market data due over the coming week. We think the payroll numbers, which are not drawn from the LFS, the Labour Force Survey, which is subject to some concern, the payroll numbers will reveal a 5,000 drop in payrolls in the UK. But keep in mind that there's some potential distortions going on there too, because given the changes in NICs, there's an incentive, national insurance contributions, there's an incentive for workers to shift from being employed to being self-employed. So maybe the payrolls numbers is giving a false impression of some weakness in labour demand. Keep that in mind. But we think a drop in the payroll numbers, and we think a bit of a drop back too in wage inflation, currently around 5% year on year. We've got a drop to 4.6% year on year in our forecast. But as I say, there are huge concerns over the accuracy of particularly the LFS data, the Labour Force Survey data in the UK. And so getting a read on the labour market is incredibly difficult. And I think that speaks to some of the disagreement on the MPC. I think one thing we can be reasonably sure about in the case of the UK is that labour demand has softened over the past few months, perhaps since the increase in the national minimum wage, but also the national insurance contributions that kicked in April. So labour demand appears to be softening. What we're less sure about is what's happening on the supply side. And obviously that's a critical component here, because it's the balance between demand for and supply of labour that determines wage growth, that in turn feeds through into inflation. So reasonably confident in the idea that labour demand is softening, much less confident in whether or not that's being mirrored by a drop back in labour supply. And if it is, then you wouldn't necessarily be cutting interest rates. But if there is no diminution of labour supply, then that would strengthen the case for further rate cuts.
This question about the quality of UK labour market data, I mean, it's been brought up in the past few days by the White House. They've been talking about what's been happening with the UK's problems with the Labour Force Survey. And it was all part of this justification for dismissing the Commissioner of the Bureau of Labour Statistics last Friday. That does look pretty concerning, doesn't it? Our colleague Jonas Golterman was actually joking on the podcast last week, shortly after the release of that horrible July jobs report, that Trump would fire the commissioner. And a few hours later, hey presto. So So is it the end of days for US data credibility, or is this just another chaotic moment in what's been a fairly chaotic presidency?
Well, I think there's a bit of perspective that's required here. I think there is a case to be answered about the quality of labour data in general, both in the UK and in the US. The revisions that we've seen to the payrolls data, not just in the July numbers, but in previous months, have been unusually large. They appear to have increased since the pandemic. And we know that response rates have declined too. And the BLS has been relatively quiet in terms of providing an explanation for all of that. And they didn't provide really anything by way of explanation for the large revisions in the July data. So I think there's a case to be questioned about both data quality, but also how that's then been communicated to some of these revisions and changes have been communicated to the markets. Yeah, that does not, in my view, amount to the case for removing the BLS chief. And there is a clear concern that the manner in which this has been done will politicize a key institution in the US that is responsible for the production of the core economic data. And so it doesn't excuse the decision to remove the BLS chief or the way in which it's been done. And it does raise some concerns about politicization of data, but nor should it blind us to the fact that the US probably still is the gold standard when it comes to economic data, but there has been a deterioration in quality, particularly on the labour market data over the past couple of years.
I mean, the Trump arguments that the BLS was already politicized, which is why you had those revisions in the first place.
That may be the case, but let's take a step back and consider this in the round. We know that the other institution that's been under fire in the economic realm has been the Fed, with the president pushing for rate cuts. Now, if the complaint against the BLS is that they're printing weak labour market data for political reasons and that their labour market's actually stronger than the official data might suggest, then that would not support the case for interest rate cuts, would it? So I think there is a general kind of incoherence to this. It seems like every institution in the US is under fire from the White House if they're not doing exactly what the president wants. But of course, the president's economic agenda itself, there's some inconsistencies and incoherence within that, not just when it comes to interest rates, when it comes to the labour market, the interaction between interest rates and the labour market, when it comes to the interaction between fiscal policy and the trade deficit, when it comes to the view about what tariffs are going to do to the trade deficit. There's incoherence every which way you look, and then it manifests itself as some of these decisions because guess what? You can't get everything that you want when you have this incoherent agenda.
The BLS is actually going to be publishing the coming week's big data release. We've got US CPI on Tuesday and then PPI later in the week. Presumably, if these inflation numbers are hot, then Trump's again going to say it's Democrats skewing the numbers. But talk us through what we are expecting from this upcoming US inflation data.
So far, there has been relatively little in the way of impact of tariffs in the aggregate inflation numbers. It's been the dog that has not barked, if you recall. But when we spoke about this last time, I said the devil will be in the detail. And the key thing is to dig into what's happening in the various components of CPI inflation. And when you start to do that, actually the last print that we had from the US, if you look at core goods excluding vehicles, actually there was quite a big chunky increase in the June number. And we suspect there will be another increase in that number in July. The puzzle has been, why have vehicle prices in the US been falling when the tariffs have been imposed on that sector? There's various explanations. Our US teams have written several notes on this. It might come down to the way in which dealers are pricing and waiting for a bit of clarity on the tariff landscape before firming up pricing decisions. And of course, you also have, away from tariffs, there's been some energy disinflation, but also disinflation in the shelter components of CPI too. Put all that together, and we've got a 0.3% increase month on month in the headline CPI number, a 0.4% increase month on month in the core CPI number. That would push core CPI back above 3% year on year. So again, the key point here is going to be to dig below the headline numbers, look at what's happening in some of the goods categories, and that's where you'll start to see some of the effects of tariffs.
And as the dust settles on Trump's trade agenda, all those tariff rates kicking in the past week, do they imply more upside risk for inflation than perhaps we'd been expecting, given how these tariff rates have fallen out?
I think it probably does, but I think the key point is to not get too hung up. It's easy for me to say this as an economist. Clearly, if you're trading the number, it's a bit different, but it's not necessarily good to get too hung up on whether the impact comes through in June or July or in August. The point is that this has started to feed through. We started to see it feed through in the June numbers if you dug beneath the surface. It will continue in July. It will roll through August and September's figures. So I think it's going to be something that builds over a matter of months and over the next quarter or so, rather than just all coming through in 1 month.
So where's this all going to leave the Fed? We've got the next Fed decision in mid-September. There's just been an announcement of a nomination for a new member to the FOMC. Obviously, the big question is who's going to replace the current chair of the Fed. But with all of these moving parts going on around personnel matters, how is that going to affect the calculus in terms of where US rates go?
I think the most immediate question is what will be the outcome of the September FOMC meeting. Stephen Mirren, the chair of the Council of Economic Advisors, has been nominated to replace Adriana Kugler on the board of the FOMC by Trump over the past few days. I think it's a pretty good appointment, a strong PhD economist, what you might think is a kind of orthodox or mainstream appointment. There's a question, though, about whether or not he will be confirmed in time for September's meeting. And also worth bearing in mind that despite the fact that Trump has been pushing for rate cuts from the Fed, it was only 12 months or so ago that Mirren was criticizing the Fed for cutting interest rates while inflation was above targets. So not necessarily the out-and-out dove that you might have expected. For what it's worth, if that CPI number comes in a bit hot, as I say, core prices in our view up 0.4% month on month, core inflation back above 3% year on year in September, I don't think that a September rate cut is the done deal that markets seem to believe. At the time that we're speaking, a rate cut now fully priced in. Actually, the market's starting to think about pricing in a 50 basis point cut in September. Just don't think the US economy is quite that weak. It slowed, certainly, but I don't think it is quite that weak to start thinking about a 50 basis point cut. And I don't think, as I say, a 25 basis point cut's a done deal either. But a lot will hinge on this inflation print. And of course, we've still got one more payrolls report before the September meeting due too.
Neil Shearing there on the Fed, inflation, data quality problems, and a difference of opinion at the Bank of England. Our usual caveat, we were recording this at 10 a.m. London, that's 5 a.m. DC time. We're going to be all over that US July CPI report on Tuesday. Watch out for our rapid response soon after the release. And then at 10 a.m. Eastern, 3 p.m. London, our US team is going to be doing a drop-in. That's one of our short-form online briefings. I will add a registration link to that event to the podcast note for clients. I'll also link to some recent notes on Mirren's nomination and that data quality question. On those data problems in the UK, I wanted to highlight our UK employment indicator, which our UK team built precisely to get around the problems with response rates in the labour force survey. It's designed to give a more accurate view of what's happening with the UK jobs picture, and in the coming week or so, the team's going to be enhancing it with what they're calling the UK unemployment proxy, which will give you a high-frequency measure of slack in the labour market. We'll be notifying clients when that proxy launches, and if you are a CE Essential or CE Advanced subscriber, you'll get access to that, along with a full suite of data tools and much more. So get in touch if you want to learn more about our all-access packages. Now, Donald Trump campaigned on a promise to create a renaissance in US manufacturing. He's talked about factories and jobs coming roaring back into America, and he's told voters that other countries are going to need to start worrying about Americans taking their jobs. But how much can the president revive US manufacturing? Thomas Ryan, an economist on our US team, has been crunching the numbers, and he put out a report recently looking at this promise of reshoring. I spoke to him just after these latest US global tariff rates went into effect, and I started our conversation by asking him how seriously we should be taking Trump's pledges.
Yeah, I'd be pretty careful assuming that this is all just bluster. It's something that our clients are certainly taking seriously because it's something we get asked about all the time. It's something that Trump pushed on the campaign trail quite a lot in the build-up to the election. And bringing back manufacturing jobs is obviously a very popular move in those former industrial swing states like Ohio, Pennsylvania, and Michigan. So in terms of if Trump wants to keep to those promises, then bringing back those manufacturing jobs is a key part of that. We've also seen revealed preference from Trump in a way to bringing back manufacturing jobs. Obviously, Trump has multiple aims when it comes to tariffs, such as bringing in revenue or pushing countries to make concessions on certain things like their own trade barriers. But I think a key one he's continually pushed since the 1980s, in that case, more against Japan, was this idea that the US has been treated unfairly from a trade perspective, and the desire to bring back those manufacturing jobs that have been lost since the 70s back to the US. So to give some context, in the post-war years, the US was known as the workshop of the world, and that culminated in the late 70s with close to 20 million people being employed in the manufacturing sector in the US. Since that point, manufacturing employment has dropped by almost 7 million, which is a 35% decline. And what you've had in that time is obviously the new wave of globalization in the 1990s that led to low manufacturing hubs springing up in places in Asia and Eastern Europe as well, that US firms weren't able to compete. So a lot of that production went elsewhere. So I think it's a pretty dire picture in terms of what manufacturing looks like at the moment. And I think even though Trump does have these multiple goals when it comes to tariffs, I think the rhetoric on reshoring and bringing back manufacturing jobs, we have to take at face value.
So the stated intention is to bring those jobs back. As you say, we've seen a massive drop in manufacturing jobs in the US since the heyday. What's the likelihood that those jobs do come back? Because the way that Trump's describing it, he's literally said we're going to take manufacturing jobs from other countries. We're going to have a manufacturing renaissance in the United States. How realistic is that?
I think it's pretty unlikely we see a manufacturing renaissance in the US. There's a lot of constraints in the short to medium term, the number one being on the supply side of the economy. So the US has a dearth of skills in the manufacturing sector. So if you look at sort of measures of labor market slack in manufacturing, it's extremely tight. So the US economy is already running at full employment with the unemployment rate of about 4%, but that rate's even lower for manufacturing. So these international exporters, although a key goal is to get tariff-free entry into the US, and one way of doing that is obviously building domestic capacity. There's the fear there that they won't be able to staff these new plants or have to pay really inflated wages as a result, because there's just a lack of skills there. And obviously that can be addressed over the time through retraining, but it's a key constraint in the short to medium term. The other constraint is that the US manufacturing sector is just so uncompetitive in most areas versus the rest of the world. So if you look, for example, at manufacturing wage costs in, say, Vietnam or Thailand or a lot of the developing markets in Asia, manufacturing wages are about 5% of what they are in places like Ohio or Pennsylvania, the former industrial strongholds. If we've got tariffs of, say, anywhere between 50 to 30%, then it's going to take a lot more than that to offset that competitive advantage that the economies in Asia have. So there's no real incentive for exporters to move their production to the States in that case.
So you don't have the skilled workforce to staff the factories, even if you build them. But also it's quite an important point, isn't it? Because we're speaking just after this latest round of tariffs have kicked in. You've now got a US effective tariff rate at its highest level since Smoot-Hawley, since the 1930s. But your point is that even with tariffs at these elevated levels, the bare fact of the matter is that wages are so much lower in manufacturing centers in Asia, Eastern Europe, compared to the US, that the US simply can't compete.
Yeah, exactly. And even if you were able to get that production in those areas, say apparels or textiles, back to the US, it would be bad for the consumer as well, right? To give you an example, Walmart's selling a t-shirt online at the moment for $4, a nice one with a chameleon on the front. If that was produced in the US, that'd be a much higher final price. Like I said, manufacturing wages in, say, Vietnam are 5% of US levels. You obviously have to adjust for the fact that the productivity in the US factory is probably going to be higher than in Vietnam. But even then, you can say that assuming labor cost is the main input for that t-shirt, which it is, you can multiply that for $3-4 by 10 to get to $30 to $40. And then you've got to factor in the fact that these sort of exporters in Vietnam are working with razor thin margins, and the fact that other input costs are higher in the US, higher tax rates, etc. You could easily see a scenario where that t-shirt is retailed for $60 if it was produced in the US.
Okay, so $4 t-shirts versus possibly $50, $60 t-shirts. But we are hearing announcements from pretty high profile companies, Apple, TSMC, Nvidia, Roche, the pharmaceutical firm. They're talking about investing in the US, big numbers, tens of billions, hundreds of billions. We're just a day after Apple announced an extra $100 billion investment in the US over the next 4 years, on top of the 500 already announced. What do these sorts of announcements signal about Trump's promise to bring these jobs back to the US?
The first thing, I think it signals a revealed preference in terms of the types of jobs that Trump and his administration want to bring back. So while we've heard and Trump's thrown around that he wants to bring back manufacturing jobs in all sectors, I think the administration revealed by this that where they're targeting the most is in relatively high value add industries. So like machinery manufacturing, electrical equipment manufacturing, for example. So I think there's definitely a revealed preference in terms of the types of jobs they want to bring back to the States. And that kind of makes sense because these industries are not only the high paying ones. And when you think about manufacturing and recreating that avenue to the middle class that many people in the US associate with manufacturing, it makes sort of sense to bring these industries back. And they're also quite strategically important. Talking about geopolitical tensions and global fracturing, having a solid domestic sector where you can produce those sorts of goods is quite important. The only sort of problem that the administration faces is that from our analysis, these are the types of industries where actually those supply constraints are most acute. So if you look at unemployment rates or any measures of labor market slack and you break it down by subsector in the US, supply constraints are most acute in those electrical equipment and machinery categories. Capacity utilization is really high relative to its long run average. So there's not really many underused resources that can be utilized in the short to medium term. And likewise, unemployment rates are even lower than the manufacturing average. Ironically, it's actually the subsectors that you might not associate with the Trump administration wanted to get back, like textiles and fabrics and printing, etc., where the supply constraints are less acute. So that creates a bit of a contradiction in terms of what the Trump administration is able to achieve and where it might want to achieve.
Before you go, we're talking about the potential for an American manufacturing jobs renaissance, just days after that July employment report shocker. Was the fine print of that report signal about the Trump administration's ambitions to kickstart a golden age of American manufacturing?
Yeah, I'd say so far the signals were all bad, but maybe we shouldn't inference too quickly. Reshoring it is a process and can take time. But if we are just looking at the July payrolls, manufacturing employment declined by 11,000. I think over the past 3 employment reports, manufacturing has shed almost 40,000 jobs. So it's not a good start. Admittedly, some of this is due to uncertainty and manufacturers pausing plans while there's still tariff uncertainty. But I think it does speak to the fact that there's contradiction here in terms of sparking a manufacturing renaissance and tariff themselves. Because I think one thing we haven't really spoke about is that tariffs raise input costs for these manufacturers. So I think a good example of this I like to draw on is steel and aluminium tariffs. We have an example of this coming into effect in 2018, where you had sort of 25% steel tariffs and 10% aluminium tariffs. So not even at the levels we have them today, where sort of 50%. But in that case, that was actually a pretty large drag for the manufacturing sector as a whole, because it raised input costs for downstream firms, and it actually led to manufacturing employment falling in those areas, but also falling eventually in metal production, because that eventually led back to production in areas. So I think we can't read too much into the last 3 months in terms of the overall direction of reshoring, even though we are pretty bearish on it overall. However, I think there are early signs of the contradictory nature of tariffs being a positive and a boon for manufacturing. And the other key takeaway from that employment report is the clear evidence now that Trump's deportations and immigration curbs are weighing on the labor supply. which is another contradiction in terms of wanting to spark this manufacturing boom at a time when there's already not enough talent or large enough talent pool of skilled workers in the US, and there's not a lot of labor market slack. So if you're reducing the labor supply or at least slowing growth to stall speed, that's going to be another thing that's going to hold back bringing back loads of manufacturing jobs to the US. It's either going to be a case of these firms won't be able to staff the plants, or they're going to be competing really hard to attract manufacturing talent, which is going to push up labor costs significantly.
That was Thomas Ryan from our US desk. His report on reshoring will be in the podcast notes, and he will be online with the rest of the US team after that July CPI release to answer your questions about US growth, about inflation, about what's happening at the Fed, about reshoring, and everything in between. Look out for another drop-in on Thursday. That's about India, all about this row with the White House about Russian oil purchases and what that means for the Indian macro and markets outlook. But that's it for this week. We will be back next week with a review of that CPI data and much more besides. Until then, goodbye.